I'm Max Keiser. This is the Keiser Report. So much to cover, so many things to talk about. Yes, Stacey.
You know what? I noticed that it's basically crash season upon us. And you could tell that because how dark it is outside all the time in the morning. Late into the morning that it stays dark. And everything on the surface seems A-okay. But under the surface, there's some sort of turmoil brewing in the financial markets. You know, we've been looking at this repo situation, and, you know, something apparently, like at least one bank survived going under in the past week or two, according to Nick Bhatia. But here's an interesting interpretation as well from Rick Ackerman at rickackerman.com. He's a former market maker and a financial journalist. And he says, repo rumpus foreshadows a short squeeze on the dollar. The Fed's so far $128 billion intervention in the repo market slipped off the Wall Street Journal's front page Thursday evening, hardly a concern. Don't be surprised if years from now, the squeeze on short-term borrowers that caused this flurry of excitement is recalled as an early warning sign of the banking system's coming collapse. On Tuesday, there simply weren't enough dollars to keep short-term loans rolling. This implies that the dollar short squeeze that I first wrote about in Barron's and the San Francisco Examiner more than 2 decades ago may have begun.
Right, the dollar short squeeze, the fascinating topic. You know, that this would be deflation, according to the deflationists out there, and how the collapse of the bond market and the credit markets have continued despite all the money printing, despite all the attempts to reliquefy banking system. Doesn't matter. The internal machinations of the bond market as it's traded internally by banks is continuing to collapse. And on the surface, this is not reported because it's too horrifying to speak of. That in fact the credit markets have reached such a state of disrepair that it's causing a run on the dollar and a short squeeze on the dollar in this way. But you know, Rick is probably correct, and you know, it's just a corpse basically, and they can't keep it animated.
We've had so much money printing, we have negative rates, we have all these things to keep the system alive, and most people feel like really great about the economy. Jobs are booming, wages are rising, house prices are booming, everything is okay. We also felt like that in 2006 and 2007 when we were reporting in the financial news at that time. We did, you know, I remember you going on France 24 when in January of 2007, there was a flash crash in the Chinese stock markets. It went down something like 15–20% in one day. And everybody around the world, including Wall Street, they were all like, what is going on? So there were like crazy movements leading up to the financial crash of 2008. And this was before they began to paper over really violently and aggressively. But so here we're looking at similar movements. This could be something or it could be nothing. But here Rick Ackerman says, regarding the run on repos, it is curious that a dollar shortage developed in one specific market at a time when dollars remain almost inexhaustibly available in so many others. Mortgage money is not tight, nor are 0% teaser loans for any credit card holder who is not in prison. Big companies have no trouble borrowing billions of dollars to buy back their shares. But borrowers in the repo market, they are potentially like short sellers of a stock that has suddenly become unavailable, which is to say, they will be dead ducks on that inevitable day when even a slight whiff of panic wafts through the battery.
The people in the repo market, the repurchase agreement business who are putting up collateral for short-term loans, you know, they don't want to lose a penny. right? I mean, it's okay to lose a bunch of people in the mortgage market. It's okay to disenfranchise the entire black community, for example, as we did in 2008 for a laugh. It's okay to crash the stock market periodically for stockholders who are unhedged and they get wiped out. I mean, or it's okay to wipe out a country like Brexit is doing because of the interests of hedge fund managers who are looking for the next Greece. That's all for fun and games. But in the repo market, it's guys with a lot of money that don't want to lose any money. So they don't trust each other. So the interest rates go higher. So they're unwilling to lose even a penny. That's why they're charging each other exorbitant rates because they're cheap.
I mean, they're only lending for overnight, and yet they're not trusting each other. The people in the mortgage market, credit card holders, those are the dumb money. Those people don't have any idea. They believe, all things are great, whether they tune into Fox News or MSNBC. They think life is forever, eternally perfect, and the Fed will always bail them out, so they're happy to spend and spend and spend. But these banks, it's asymmetric information. They know a little bit more about the true state of the debt and the derivatives and the deflation that might be coming down the road. They also, many people are assuming that this was perhaps one bank like Deutsche Bank that is insolvent, and so we won't know that until later. It could be a hedge fund, some people are suggesting as well. So we won't know. The fact that we won't know until it's too late is part of the problem. This time the Fed handled the problem without breaking a sweat. The next time, however, the cost might run into the trillions of dollars, which is to say more funny money than the central bank can gin up on short notice. When this day of reckoning comes, the banks won't open the next day, nor will credit card transactions clear. Although there is no way that even a prudent person can completely protect him or herself from the fallout, it seems likely that those who hold treasury paper and gold bullion as insurance will fare better than those who don't. And Rick just does go on to say, that gold is looking good at these prices, and in this situation that it's better to get it now while these just little tiny signals, these smoke signals, are sent out occasionally, that you're seeing the early, the tremors ahead of perhaps a bigger earthquake.
Yeah, it's always interesting. It fits into that scheme or idea of interest rate apartheid, where, if you're not part of the in crowd, you have to pay exorbitant fees on your credit cards. You're living in a Bantustan of bad credit by design. It's a way to keep the society in check from uprising, right? Because if you are keeping them always in debt. And on the short-term credit crowd, those are high-quality credits, and they wouldn't dare take any risk at all. And, you see the same thing in the way food is regulated, right? Because for a large part of the population, they have a certain standard in the food regulatory regime about a certain number of rat hairs that they allow in your food, for example, and that are acceptable. But for people who are dining on the short-term credit market, it's always foie gras and champagne of the highest possible standard. It's food. It's apartheid in the food business. Everywhere is apartheid now. That's the model. Whether it's food, credit, security, drugs, pharmaceutical, opiates, heroin. It's just, we live in a new apartheid state.
Of course, that we live in a command and control financial system. This is possible under fiat currency. However, the problem is that there is always an underlying real economy and real banks and real debt that has to be paid. So the fact that we have a command and control around a real economy that's never worked, because eventually the real economy rises up and they overwhelm the control that you have over it. So whether or not we're at that moment, it could go on another year, another 3 years, another 10 years. But at the end of the day, we're at the end of a system of this fiat control, command and control. And, I mentioned, so here you had the repo market, big banks, primary dealers lending to each other overnight and using supposedly great collateral as the basis, and yet they couldn't even borrow for 10% overnight. Here on the other side, here's a story from mishtalk.com. House flipper lending hits 13-year high. What can possibly go wrong? The dollar volume of financed flip purchases in the second quarter of this year jumped 31% annually from 6.4 billion to 8.4 billion, according to Atom Data Solutions. That is the highest level since the third quarter of 2006. So home flipping is back, and lending to home flippers is soaring. It's up 31% in this second quarter of this year.
You talk about the real economy and how these things impact the real economy. Well, in the real economy, companies' earnings are going down. You know,
yes.
S&P 500 earnings have been going down for 15, 16, 17 years now. It's masked due to stock buybacks, but
yes.
the actual companies losing money.
Yes.
Retailers are shutting down by the thousands across America. You go to the malls now and it's half empty. And wages, of course, are going down. Adjusted for inflation, they're going down even more. The real economy is dying. It's close to completely dead. The financialized economy, the fake economy, the home flipping economy, the repo market, up, shook, boogie, and jive economy, because I've got to make a payment on my yacht in Greenwich because I'm an ex-long-term capital management fraudster living in Ossining and I need to quick cash. Hey, that market is doing great, but that's not the real economy. That's a market driven by potentates and charlatans and neo-feudal meisters sitting on their throne of easy credit spigots. That's not real.
But the repo market signaled something is going on at the very, very top. Those guys own yachts. The people not lending to each other weren't even able to borrow for 10% overnight. Vipin Motwani, however, an investor with Iron Gate Development in Washington, D.C. area, expects to flip about 15 homes this year, he says. It's always smarter to use a mortgage because you get leverage. You can do many more deals, right? Said Motwani. Also, the banks have become a little bit more easy in lending on this flip business. It used to be a lot tougher. So the dumb money is pouring in. The money is there for the dumb money. It's easy for them to borrow. It's easy for them to flip. This also happened in 2006, right before the world economy, the real world economy, went over the cliff.
Right, true. We saw this in 2006, which portend the 2007-2008 crash.
The liquidity crisis.
The liquidity crisis. So, cue Peter Schiff. You're back. All right, we're going to take a little break. When we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Mark Yusko. He's the CEO of Morgan Creek Capital Management right here in North Carolina. We're going to get to his thoughts on Bitcoin in the second segment, but first, we're going to discuss all things the current legacy fiat system as it continues to disintegrate. But first, Mark, I got to ask, is today kind of dress down Monday for you down there?
It is. I forgot the suit
and when you're on the CNBC, you're always wearing a
tie.
tie and a suit. You come on my show, and it's like, oh, I'll just wear my casual clothes. What's that all about?
Well, you know, watching all your tweets over the past couple weeks traveling around the world, you're pretty cash, but now you're suited up, and I'm not.
All right, let's show your socks. Let's get the socks.
I got the flamingo socks going.
Can you get a shot of the flamingo socks? Flamingo.
Yeah.
It's not flamenco. That would be a dance number.
That would be a dance.
And
but these are the Fiat Flamingos.
Fiat Flamingo socks. Okay, well, more about that later. But first, let's discuss. Oh, I shouldn't do that. My sound guy hates it, but it's too late now. Sorry about that. The repo market.
Yes.
What is it? And how unusual were the events of the past few weeks? And what, in your mind, is it telling us?
Well, it's telling us that there is a shortage of dollars around the world.
How can that be? Because I thought they just print them up all the time, willy-nilly.
I think that is the common misperception, is that they are just printed out of thin air. And I think the challenge is that, you know, when massive debt is issued or incurred and then issued by the government, someone has to buy it. And what happens is the money then transfers to the Treasury, and the Treasury then hoards those dollars. And so other people around the world have to scramble for dollars. And I think that's what we're in the midst of here, is a global scramble for dollars. That's why you see a little more strength in the US dollar than we probably would have anticipated, given that they're devaluing it every single day by printing more of them. But the one other piece that I think is interesting here is the information content of the Fed having to intervene in the repo market. Everybody says, oh, it's not a big deal. $300 billion is a big deal. I don't care, who you are or who you aren't, but it's a big deal. And I think what it tells us is one of the banks, perhaps more than one of the banks, but at least one of the banks has a capital shortfall. And that's what's having to be shorn up here.
Is this the beginning of quantitative easing? Some have speculated that this is just the first steps. That
yes,
the government coming in and they're on the short end, but eventually this will become the medium and longer end. And this is kind of the beginning of QE4. Do you agree with that?
I think we're in QE forever. Forget QE4. I mean, it's QE forever. My accent was less good than your North Carolina accent.
That's fine. We're going to go to another question because you mangled that so badly. Let me ask you about this dollar strength for a second. So I know I said I'd get to Bitcoin later, but I got to ask this now.
Yeah.
Bitcoin has become a risk-off safe haven asset. Generally speaking, that's a meme that's been circulating recently. So with the dollar strength, is that causing a little headwind? Because we've seen Bitcoin has been, 10,000 back to 8,000. It's been stalling.
Yep.
Gold also stalling. And people are making the equation between gold and Bitcoin being similar.
Yep.
So a dollar strength, it poses some headwinds to both these assets. Yes or no?
Correct. Absolutely. And one of the things that should occur in a environment where the dollar weakens, right? The dollar should weaken if they're creating more of them. That should actually be good for real assets. But to your point, we're seeing the exact opposite. We're seeing a scramble for dollars, dollar strength, and a weakening across the board of real tangible assets, gold, oil, commodities, and Bitcoin.
So that signals on a big macro picture here, if we can extend this a little bit, deflation.
Yes,
right?
Killer Ds. I talk about the killer Ds all the time. So we have bad demographics. Every single day in this country, 10,000 people turn 65. Same thing in Europe. So we got too many people who are older, non-productive, non-spenders. Not enough working age population growth. We have debt, massive debt. In fact, the deficit and debt, more Ds, are rising at an alarming pace because of the fiscal irresponsibility in Washington and Brussels and elsewhere, actually in Tokyo as well. So you got massive debt in the developed world, and that all leads to ultimately deflation. And what's interesting, if you go back to the original quote, I think it was Thomas Jefferson who said, if the American people ever allow banks to issue money, they'll have their future stolen from their children, first by inflation, then by deflation. So we had the inflationary spike in the 70s. Now I think we're in the deflationary death spiral.
Okay, deflationary death spiral. So this has been with us for a while now.
Yep.
And the answer going back 10 years, going back to 2008, was, we're going to print a lot of money to bail out the banks.
Yep.
And some economists out there were saying, well, that'll cause inflation.
Yep.
We'll see gold spike. Didn't happen.
Didn't happen.
And in fact, we've seen increased amount of deflation.
Yeah.
And the deflationary death spiral, as you're calling it, seems to be exacerbating. And can we therefore conclude that this idea of printing money is not fighting deflation, but are at the point where you can say it's causing deflation?
Causing deflation, absolutely. There's no question that if you print more of something, you create more of something, again, out of thin air, it will devalue it. And that has been the playbook really since the turn of the century. I mean, I have this great chart that I talk about all the time. From 1776 to 1913, the dollar was roughly worth a dollar. Now, it had ups and downs around the wars, Civil War, et cetera. But from 1913 to today, we've turned a dollar into a nickel. So there's a joke from Jay Leno. He says, there's a rumor that the Treasury wants to convert from paper money to a coin. Well, they already have. It's called a nickel. And so they've been doing a good job. And to your point, if you think about the issuance of currency, particularly in the QE form to bail out banks, that's what the central banks do. That's their job.
Okay,
right?
banks,
their job
let's talk about
is
that for a second.
Enrich themselves.
When you're bailing out the banks, and banks that should not get bailed out because they made horrible loans, they made horrible business decisions, if we live in a free market capitalist society, they should go bankrupt and be replaced with competitive banks. But by feeding the zombie banks, as they're called, you're crowding out those businesses that could create productive, wealth-generating businesses and jobs.
Always.
Right? So that money printing, if it went into a velocity of money,
Yes.
if there was a real business creation, SME, small to medium enterprises, then you might get an uptick in the economy. But it keeps going to these zombie banks.
Of course, because that's the only people that get access to Fed funds. I ask people all the time, do you borrow at Fed funds? Well, no. Do you get your mortgage in Fed funds rate? No. Everybody else has the problem that the banks borrow from the Fed and buy treasuries. That is a riskless trade. They lever it up, 11, 12 times. JP Morgan last year had 0 negative trading days. Trading implies taking risk. You can't have 0 negative trading days. Well, it's because they're not trading. They're just levering up treasuries. So it's all a big cabal, a banking cabal. And the problem is it's run by the bankers themselves, right? The people who control the central bank are the heads of JP Morgan, Goldman Sachs, Morgan Stanley, Citi, the New York Fed and the Treasury. So those 6 people, as I like to talk about them, the plunge protection team, they get together on Sunday nights and they decide who they're going to bail out. They bail out their friends and their cohorts, the banks, and therefore banks then don't make loans anymore. So people have to get loans from fintech companies, from peer-to-peer organizations. So if you look at the velocity of money, as you described, it has been plummeting for decades. And it's not going to get better because bank reserves that don't get lent don't create inflation the way that some of those economists were worried about. To your point, it creates deflation. And that's
right, so
where
the economy is a car, and the banks are like, got a big hose, and they're siphoning off the cash, the gas.
Yes. Well, in fact, it's worse. You watch Stranger Things?
Sure.
The show Stranger Things? So, everyone knows the story about the Wizard of Oz was really about gold standard and the president taking us off the gold standard. So what's interesting, I was going through watching Stranger Things, and the mind flayer, the big thing that sucks the life out of Billy at the end. And I started thinking, wait a second, I've seen that before somewhere. In 1910, a guy wrote a book about the creation of the Fed, and he had a picture of this octopus that had its tentacles around the companies and all of middle America and the banks, and then out of his mouth, he was upchucking money into the banks in New York. And I was like, wait a minute, they look exactly alike. The mind flayer and this, octopi look exactly the same. And then I looked at the Federal Reserve Bank building, and it looks like the National Labs building from Stranger Things.
Right,
it's a little freaky.
The crossover between pop culture and finance, Robert Prechter used to write about this a lot. He was big in the 80s with the Elliott wave theory. Yeah. And you do see some interesting connections, and a lot of times pop culture reflects what's happening in the economy and vice versa. So this brings us to, of course, the big question is, okay, what is the cure?
Bitcoin. I mean, it's one cure.
Before we get to hard money, what would be, if you were running the Fed, what would be the cure?
Well, to shut down the bad banks. Would be my cure. And look, it's a painful cure.
What about raising rates?
That's a good cure too.
Isn't it?
I like that.
Right?
Absolutely.
Just raise rates, because now the people who are only survive on cheap money because they don't have a viable business would go out of business.
Yes.
Right?
Well, look, that is absolutely the cure. 100% agree with you. And it's so funny. Back when Ms. Yellen was still Fed chair, I was on one of the mass media outlets, and they asked me, what do you think she's going to do tomorrow? And I said, well, I think she's going to do nothing, but what she should do is raise rates from 0 up to 3%. And literally Melissa went crazy. What do you mean? Well, that's what she should do, but she won't do it because that would put a lot of people out of business and cause a recession, and people are afraid of recessions for some reason. And recessions, I have this thing, #MRGA on Twitter, make recessions great again. Recessions are not bad, they're not evil, right? They cleanse the bad businesses. It's like every once in a while they burn, around here.
Capitalism has ups and downs, okay? Socialism is flat, and no ups and downs, but everyone's equally poor. Right? Okay, in capitalism,
you're equally unhappy and equally,
Right, you have these ups, but you need the downs.
Yeah.
Or you end up with just this flat kind of economy where you have a kleptocracy at the top who are fed with these low rates.
Well, to your point about pop culture, right? You talk about zombie companies, zombie apocalypse. We got zombies on TV all the time, right?
Right.
The Walking Dead shows are everywhere.
Movies, that's all
They're
there.
everywhere. And so that's what we have. We have zombie companies. 38% of the S&P 1500, so the 1500 biggest companies, could not, in the last 3 years, service their debt with their EBITDA. Forget paying off the debt. They could never do that. They can't even service their debt.
EBITDA being like adjusted cash flow.
Exactly.
Right? So they can't even service
They can't
their
even
own
service
debt.
their own
They
debt
have to buy,
with their cash flow. They have
but
to
their
borrow
earnings are
more
going
money.
up because they're buying back their own stock.
Oh, look, Apple, not a bad company, good products, made the same amount of money last quarter as 2015. Exact same amount of money. But their earnings per share went up 20% because they issued debt and bought back so much stock. Look, that's stealth QE. If you look at buybacks, it is just QE. The Fed is not allowed to buy stocks, like it's Swiss National Bank or Bank of Japan. So I believe the Treasury and the government in Washington went to the big companies and said, we'll cut your taxes. One condition. You have to take the money and buy back stock to keep this Ponzi going.
Right. Okay, we're going to carry this over to another segment, but we got to say goodbye for now. Thanks for being on the show.
Well, thanks for having me. Always great to be with you.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank our guest, Mark Yusko of Morgan Creek Capital. If you want to catch us on Twitter, it's Keiser Report. Until next time, bye, y'all.